All right, we'll let you guys file into the room. If you are looking for Tax Tuesday, you're in the right place. And we may even have some betting advice for you. Apparently, we got a bunch of degenerate gamblers on. Just kidding. Uh, no, we're done with soccer for a while.
Yeah, well,
The
it'll be
football,
back though.
it'll be back. My God, my wife's Colombian, so of course we were rooting for Colombia on Sunday, and
We'll go.
they hadn't lost like in 2 years either. It was like 28 matches. All right, enough of this. You're here for taxes, so let's get jumping in. So if you're looking for Tax Tuesday, you're in the right spot. Tax Wednesday's tomorrow. But my name's Toby Mathis, and I have Elliot here with me,
Yes. Hello.
and we're here to answer your questions. Yay, Elliot! I didn't give you the applause that you deserve. Elliot suffered a serious injury last time, 2 weeks ago. What happened?
I had a healthy cracker crack my tooth.
A healthy cracker cracked. Is this so? Everybody out there who's eating healthy crackers?
Stop it.
Mm-hmm. Yes, but
But
I'm glad you're back.
our buddy Troy said, a Lay's potato chip would never let you down like that, Elliot.
That's true. All right, let's see. Let's go over some rules because Patty's already spelling it out. So, welcome, Patty, and we have a whole team, by the way. We got Matthew, Patty, Amanda is in the house, and Arash, and Dutch, and Jared, and Jeff, and Rachel, and Tanya. Like we get like all these accountants are floating in here, and they're here. Somebody says Weetabix. It won't hurt you either. It would hurt you. It's going to hurt your insides. Weetabix, I'm pretty sure you're going to have some intestinal difficulties later. I don't know. I always look at those things and I immediately think,
Ooh,
Gonna
gonna regret that one.
yeah, maybe want to skip it. All right, well, let's get into the rules though, because Patty's already spelling them out, which is ask your questions. We have a bunch of accountants and tax people in the Q&A area, not on chat, in the Q&A area. And yeah, you could absolutely ask your questions in there. Somebody just says, "Oh, sorry to hear about Elliot. Stick to bread." Yes.
Good
Yes.
call.
Yes. All right. So Q&A, and then you can put your comments into chat, like Elliot, where learn to chew or whatever. Patty says sourdough's yummy. All right, that's what you use chat for. Q&As for your questions. Also, if you have questions, because we do these Tax Tuesdays every other week, you can email in your questions. Elliot likes to answer them and also pick them out randomly to make them questions that we are going to be answering. So if you just need general question answer, do it today. It doesn't cost you a nickel. If you need extensive answer, like if our guys are really having to dive into the tax code for you or answering specific things on your return, you got to become a client. And it's really, really inexpensive to become a client of Anderson, our platinum program. I always say this, it's less than $100 a month. And you could ask all the questions every day in our knowledge room. We have accountants and attorneys there. You can ask away to your heart's content. You'll never get an hourly bill if that's what you're doing. So if that's you and you're just like, hey, you know what, I need general guidance. I don't think anybody has anything quite like that in the country or in the world, as far as I'm concerned. Anderson Global is our parent company, and we have businesses in the Caymans, in Switzerland, and Italy, in Dubai, and where else do we have? France and Singapore. And I can tell you, nobody really does it like we do here in the U.S. Go USA. All right, enough of that. It's supposed to be fast, fun, and educational. So let's get into the education. Here's the questions for today, and I'm just going to read these. If this is your first Tax Tuesday, actually, let me know. If this is your first Tax Tuesday, give me a thumbs up. There's probably a reaction button somewhere on your little bar there. Oh, there they are down there. And first off, welcome. And there's a lot of thumbs. If this is not your first one, give me a heart. Give me a heart. I think that I'm doing this right.
Oh, there we go.
So
Okay.
if you've been before, all right, you guys are old hats.
We got three of them.
So you'll have to show the newbies how it's done. All right, now you can't. We don't share the chat because there's always a Nigerian prince asking for money or an insurance guy who's got something that he's going to sell you. So we can't do that in chat because there's just so many people on these. Sometimes it's over 1,000, sometimes it's hundreds, but they like to pitch each other. So we shut that down. But what this is all about is going through these questions. You could ask your questions in the Q&A. You could ask clarifying questions in chat of the topic that we're talking about. But I'm going to go through these questions, and then Elliot and I, really Elliot, is going to answer them because he's smart. You ready? And Elliot's going to answer them. There we go. I can't apparently touch a button anymore. I'm like, okay, there's Howard Dean showing up. I know it's primaries season, whatever. He always shows up. All right, so here's the questions. We are starting an S corporation for physical therapy home health business. My wife and I will be the only shareholders. My wife will run the business and see patients. I only plan to invest into the business and be a limited partner. Will my distributions from the S Corp be considered as passive income since I am not materially participating in the business? Great question. We will answer that. If you started short-term rental activity in November 2023 when the property was purchased, can you use cost segregation and bonus depreciation in 2023, or is it still better to wait until 2024? Good question. If I buy a house in September and use it as a short-term rental for a month until October and then do long-term rental starting in November, for the STR, short-term rental, I or my spouse will actively manage the property. Can I still take the bonus depreciation in first year and offset my W-2 income? So you got some short-term rental folks asking questions this
Had a lot of questions about that.
Okay. If I put money into an opportunity zone and then sell after 10 years, does it all come out tax-free or just any growth? Good question. If you are an S corporation and pay yourself a regular salary, but also take money from what Intuit calls owner draw, how is that taxed? So we're following Intuit now. Whatever, no, I know what you're saying. Do all employees have to be W-2 employees under an S corp, or can they be contractors? That's pretty funny. I'm going to play with you later. All right. Can an IRA balance be transferred to a foundation tax-free and also allow the owner a tax deduction? Can I create the foundation and operate the foundation receiving the contribution? That's a really good question. I like that one. I love it when we get charity stuff. So it makes me feel happy. All right. We sold our first flip at the beginning of the year and would like to know if there is any way at this moment to save as much as possible from being taxed, i.e. invested in the next flip or something else to avoid the loss, quote unquote. Don't know what that is. Also, if we have a loss for our S Corp in 2023, could we see that capital gain to be offset in 2024? You're having fun with this one.
Well, yeah.
You picked this one for a reason. Like
Yep.
you know, like all you accountants out there immediately losing your minds because of the terms being used, but we'll get that.
Yep.
All right. What are typical operating and general expenses you've seen overlooked when investors file deductions? Pretty general question, and we'll get to those. Couple more. Can I move into a rental house I have for 15 years? Does it still qualify for a 1031 at a later date? So if I assume you mean when you move into it, it says a primary residence, or does it qualify for a 121 exclusion after 2 years? Good questions, and I'll break it down for you. That's actually a really good open-ended question because there's so many things we could do with that. Can you do a lease option assignment in a Roth IRA? Can you do a sandwich lease option in a Roth IRA? Great questions today. So, Elliot, I'm just going to give you a little bit of applause because these are really good questions. Yeah, but now they're piling on. They're all cut off. All right. So if you have, first off, we're going to go and answer each one of those. In the meantime, you should know that if you can't get enough of Tax Tuesday, there's 855 videos up on my website, up on YouTube right now. And Clint has his own channel as well. You can, they'll probably send a link out. It's free. If you haven't figured out that Anderson likes to educate for free, well, you haven't hung around us long enough. We'll teach you till the cows come home, whether you're a client or not. Tax Tuesdays are open to anybody. You can always invite folks in, especially those people that you know are doing some weird stuff and maybe need some better advice. We'll put them on the straight and narrow pretty quick, and it won't cost them a nickel. But you can go to YouTube. Please subscribe and please share videos that you think are important to those that you think they could be important to. And then we always teach. We're doing tax and asset protection workshops. I think we're teaching one. Like I think Clint's on it right now. We're like he's roadkill right now. We just took all of his people, just brought him right over here. Just teasing. Uh, Not really. But yeah, I know that he's finishing up the tap for today. But we are teaching another one. It looks like the 27th of July. And then we have our live 3-day tap event, tax and asset protection 3-day, that is going to be in San Diego. And I would invite you to come to that. Those are not free because we actually have a bunch of overhead to cover, but they're very inexpensive. So look for BOGOs, buy one, get ones. Look for deals if you're platinum and titanium. And it's always fun to get together in live events. And every now and again, Elliot actually shows up at one.
Yep.
Every now and again.
Yeah, they're a good time.
Yeah, no, you know what's cool? Hanging around investors
Yes.
and
A
hanging
lot to
around.
learn.
Yeah, yeah. You learn so much just being around people that do it all day long and investing all day long. And it's always fun. All right. Ignore that slide. Here we go. Let's dive into the questions. All right. We are starting an S corporation for physical therapy, home health business. My wife and I will be the only shareholders. My wife will run the business and see patients. I only plan to invest into the business and be a limited partner, sit in a corner and do nothing. Go over there, right? That's what you're going to do. Will my distributions from the S Corp be considered as passive income since I'm not materially participating in the business? What say you, Elliot?
I think it's a fantastic idea. I like the thought process, but no, it's all going to be active income. And the reason why is those same rules that we talk about all the time for material participation for a short-term rental or as a subset under our real estate professional status. It applies to any business, including this S corporation for physical therapy. So in other words, if two spouses are members of it, by default, if one's material participating, the other will. So we can't get any passive activity in there. As much as we like it, I mean, I like your thinking, I really do, but it's not going to work in that case. And in fact, in looking a little bit more into this, they've even covered where, well, what if you didn't own, what if your spouse owned 100% and you just did a little work on the side? They would still pull your hours in and make you active as well. Not that you'd be getting any distribution anyway, but your hours could be counted towards the other spouse becoming material participation.
So you just burst their bubble like
I
that.
I did. But I like the way, they were trying to think outside the box.
Hold on for a
Yep.
second. So what is passive income and how is it taxed? Passive income out of an S Corp will be taxed as ordinary income anyway. So whether it's active or passive, it does not matter if you're receiving profits out of an S Corp. So long as your wife is receiving a reasonable salary for what she's doing for the business, it's taxed as though it's passive anyway. It's not subject to old age disability and survivors insurance. It's not taxed as Medicare. It is no employment taxes. The only tax is your federal income tax, and it's going to come to you via a K-1 that you're going to put on your 1040. So here's the truth is it doesn't matter whether you're passive or not. You're not going to get hit with the employment tax. And that's all we care about, except, passive income is offset by passive losses can only be used against passive income. With a few exceptions, right? Active participation or real estate professional. So this is actually better for you that it's not passive. So again, depending on whether you guys make a whole bunch of money, I'll make it real for you. Let's say that you make $300,000 and your wife takes a salary of 50 and you have $300,000 of profit above that, or, we do the math either way. So either, hey, after she takes a salary, there's 300,000, or there's $250,000. That 300, we make sure she takes a salary. Either way, that big chunk of money, either the 250 or the 300, depending on however you guys want to do the example, is not subject to Social Security taxes. And it's the same thing that you would get if it was a passive activity. So if I was pizza shop, where's my pizza? I need my pizza.
Pizza.
And it's
Pizza time.
It's pizza time. So Elliot and I, we do a pizza shop. If you haven't been with us, you know that we've been playing with pizza for years. But Elliot and I open up a pizza shop. We're not married. Elliot works. I don't. Those profits come out. I'm passive. I'm a passive owner. Okay, so that's passive income to me. It doesn't really matter from a tax standpoint for our purpose if it's income. The only time passive actually matters when you have passive losses. And then we're looking around for passive income to offset, right? And that's why really rich people like to be passive owners in pass-through businesses, because they have all these passive losses from the real estate. Rich people love to buy real estate and then create big fat losses, as you'll probably hear, because with all these short-term rentals and stuff like that, looking around and people talking about depreciation, I know we're getting into some waters where there could be some serious tax relief, and they're looking at it going, man, I need to be passive in these things so that all my rental passive losses will offset it. If you're making money, it doesn't really matter as long as it's not subject to employment taxes, and that's the big one. Anything to add to that?
No, I think that's pretty much it.
Pizza.
All right. Where do I? No. I'm trying to move this thing ahead and it's not. There we go. Helps if you press the right button. All right. If you started short-term rental activity in November 2023 when the property was purchased, so let's assume that you bought a house and you're going to make it into a short-term rental, which is 7 days or less on average. Can you use cost segregation and bonus depreciation in 2023, or is it better to wait until 2024? Elliot.
Ultimately, you're going to want to calculate first, but more than likely, you're going to be better off in 23. Why? Because in 23, we have that declining bonus depreciation right now. In 23, it would have been 80%, 24, it's 60, continues to go down. So all things being equal, conventional wisdom would say probably in 23 is when you want to do it. But let's say you didn't have a whole lot to work with there as far as income hitting your return, and maybe you would be better served by having a heavier loss in 24 despite the decline. It could be that you'd want to wait to 24, but I'd say probably most people won't.
Yeah, there's 3 rules that we always follow in tax, and they are as follows. They're very simple. Calculate, calculate, calculate. So in this particular case, we have a short-term rental activity, which means it's an ordinary business. So if you are materially participating, that means we could create loss in 2023 that we use to offset 2023 income, even your wages. If it's short-term rental, 7 days or less, you're materially participating, it is not a rental activity. It's considered a business activity, and the loss can be treated as ordinary and offset your W-2 income. So you put a building into service right at the end of the year in a regular business. So let's go back to
Pizza.
and pretend that we opened up a pizza shop and we bought an oven. And we said, let's depreciate that oven. Say it's a $5,000 oven. We could write, if we put it into service before the end of the year, we can write that off. Your house is an oven. When you're doing short-term rental activity, that means that if we can make a part of that house into personal property, which you accomplish by doing something called a cost segregation, and you take the house and you say, here's the 39-year property since it's short-term rental, here's the 15-year property, here's the 7, here's the 5, and these ones, the 15, 7, and 5 are considered personal property, and you can accelerate that depreciation. That's that term bonus depreciation. It's under 168K of the code. If you want to write that down, 168K, you'll in bonus depreciation. You can Google it up and get a really good understanding. It just means something that has a 5-year lifespan, or 7 or 15, you could take a percentage of it immediately. In 2023, you could write off 80% of whatever that total amount. Usually it's about a third of the building. I could write that off and create a loss that I could use against my W-2 or other income. You could wait until 2024, but 2024, we're going to still have to qualify as a short-term rental, which means the average stay per guest is 7 days or less. So you take the total number of days you rented the house out for the year, or you used Airbnb or VRBO, and you divide it by the number of bookings. So like if you had 200 days and you had 70 bookings, then you're going to be at somewhere around 2.8 or whatever it is, right? So you're clearly a trader business. Then, did I materially participate? If the answer is yes, then any loss that I create, and by the way, previous question, right? One spouse could qualify for material participation for the entire return. So only one of you actually has to materially participate, gets aggregated, or if you guys both do it, you can add up your time to qualify. There's 7 tests. I won't get into them, but it's pretty easy to qualify if you're self-managing. But then that loss you could use and wipe out a bunch of your W-2 income or a bunch of your other income. But we get to choose which year we pull the trigger on that bonus. We can choose all the way up until it's going to be about September 15th this year, depending on how it's held, for 2023, which means we can go back in time to November of 2023 and say, I'd like to take that depreciation now. If you're facing a big tax bill and you don't want to pay it, maybe that's what you do. Flip side. Hey, I didn't really make much money in 2023. I was in a really low tax bracket, but 2024, I've been killing it. Maybe we wait and we make the election. We could even do the cost seg study now and apply it in 2024. And as we sit right now there's legislation that might change this. As we sit right now, bonus depreciation has been reduced to 60%. I believe the House has passed legislation to knock that back up to 100%. And we haven't seen the Senate take action on it. We'll see. Maybe not. And it'll be interesting to see what happens given the presidential election. Like somebody may get off their duff and say, yay, here, real estate investors, here's something for you. We'll see. We'll just, holding our breath for these politicians. But that's how it works.
Exactly right.
Thank you, sir.
And these all build, like you said, the previous question and what we're going to see here in the next one, it's all kind of building up your knowledge on it.
Yeah. You guys realize how powerful a short-term rental can be? Could offset your income. Give me a big thumbs up because I like reactions. If this is something that you look at and go, man, I would like to offset my W-2 income. Maybe you're making $200,000-$300,000 a year. This would be something, a bunch of thumbs. Then short-term rentals become your friend. Now you're not stuck into keeping it as a short-term rental. So in this case, I'm just going to add a fact. In 2023, we did it as a short-term rental, and then we turned it into a long-term rental in 2024. You could still choose to use the short-term rental as ordinary loss in 2023. If you converted it in 2024, now we have the passive activity loss rules to deal with, right? So then we're going to have to be an active participant or a real estate professional. But that's why you hire guys like this.
This guy.
Yeah, not me. I don't work anymore. Pretty much do nothing. But Elliot here would love to tear apart your return and say, here's a bunch of money that I could find you.
And there's about 10 other people on here today who do the same.
Yep, we like digging into returns. I say that because these guys are really, really good at finding money. And here's some free money. It's like Christmas or whatever holiday you celebrate, and you get free stuff, right? That's what I look at. Who likes free stuff? Give me a heart, because I'm doing that today.
There it is.
If you like free stuff.
You got scared.
Not the ooh face. See a bunch of ooh faces.
There's some love.
All right, there we got a little bit. I'm pandering today for reactions. That's just how I roll. All right, if I buy a house in September, gosh, is this the same question?
It almost is.
Yeah. All right. If I buy a house in September and use it as a short-term rental for a month until October, then do long-term rentals starting November. For the short-term rental, I or my spouse will actively manage. Can I still take bonus depreciation in first year and offset my W-2 income? Holy crap. That's a really interesting question. Go for it.
It is. And Toby's already answered this. You just have to be able to piece it all together. It's all going to look at how much time did you rent it and what was the average stay. That's what's going to determine the definition short-term rental versus long-term rental. And the most common metric we use for short-term rental is going to be 7 days or less. If the average stay is 7 days or less, it's going to be short-term rental.
Mhm.
So while I respect what they're asking here, trying to show we had some short-term rental activity and we had some long-term, it's really not, that's all in a sense immaterial. How many times did someone stay there? What was the average stay? And that will determine if it's all going to be, you're not going to break it up throughout the year. It's either all going to be short-term rental or it's all going to be long-term rental. So we don't get to pick and choose.
It's per calendar year. So you bought a house in September and you used it through October or until October. So that's 1 month. So let's say that you did 10 3-day rentals. So you have 30 days 10 rentals, and then you get one tenant for 90 days. You have 90 days plus you rented it for, what do we say? 30 days? Did I say 30?
Mhm.
Right. So we have 120 days. We had 10 rentals short term, one rental long term. We add them up. That's 11. So you would take whatever that adds up to be 120 divided by 11. Your average daily usage is almost 12. It's a long-term rental. It's a rental activity. It's not a trade or business. Now, hopefully you're going to see something here. It might make sense to not rent it out. So I have, let's say I did 10 3-day rentals in September, but it's an expensive house and I make good money, but that house could yield me $150,000 of deduction. And that $150,000 of deduction is worth, let's say 40% to me with my state and federal. So maybe I'm looking at it going, that's 60 grand. I think I'll not rent it until December. I'm like, I'll sandbag it because now we say, let's say we had 30 days there, 30 days of September, add those up, and we're at 60 days divided by 11. You're at 5 point something days. It's a short-term rental. You following me? So it might make sense to sit back on it and go, whoa, 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 whoa. Short. I'm not going to rent it for a little bit, and I'll bypass receiving rents. Maybe I bypass $3,000 or $4,000, whatever it is, but I'm going to get an extra $60,000 in tax relief. Again, that's what this guy does. Not me. Because
That's what they do.
I feel like they got, like, you ever seen that commercial? I'm not going to get it, given what happened this weekend, but it's the hunter, and he's pointing at the deer, and the deer's going like this. I'm like this, but I know we probably shouldn't talk about stuff like that. Horrific events, the weekend. All right, but I can't help it. What is that? What are those commercials? Those, you know what, the little cartoons?
Yeah, I have seen, but
I can see it in my head, but one of those things that always stuck on me. I was always
I know
like,
Chick-fil-A has a lot where
okay.
it points to they point to the cows.
Yeah,
Chick-fil-A does that a lot,
okay.
yeah.
We'll do the Chick-fil-A. We're pointing at the cows. Eat the cow. Right. Here's the cow right over here. Apparently I'm the chicken. All right. That's not good. We're not going to do that. All right. Seinfeld. Why do chickens always point at the cows? All right. That's enough of that. All right. So next one. Let's get past this. I think we've done like 2 questions and it's 5 o'clock. Right. If you put money in an opportunity zone and then sell after 10 years, does all of it come out tax-free or just any growth?
So first of all, I just admit I did change this question a little bit because they had asked for 9 years. It is 10 years in the code. If you hold it for 10 years, that is, well, first of all, back up. What is even going on in an opportunity zone? If you've had capital gains, you sold some stock, sold some property, you have true capital gains, you can invest them in what's called an opportunity zone fund. Opportunity zone fund then invests in an opportunity zone, a land, a building, what have you, maybe a business, and it will defer your capital gains up to the end of 26 approximately. And so you won't pay any tax on them. Now, at that point, you're going to have to pay tax on that deferred capital gain. We can't get around that. But any future growth, so Toby invests in an opportunity zone. He pays his capital gains tax at the end of 26, but he keeps the building and it increases in tremendous amounts of value over a decade to 10 years plus later. Now, when he sells that, it's treated as if his basis goes all the way up, so he has no capital gains. And if we have no capital gains tax, we don't have any depreciation recapture. That is huge. Not saying go out there and invest in these because there's a lot to them, you know, and you want to be careful where you're investing. These are not always the best, you know, areas, but there was a lot of carrot to that stick when they put it out there.
Yeah, and I don't know. I always looked at it as a red herring. It's causing people to invest in places they wouldn't otherwise invest. And I say that's not good. There's rules you have to follow, like improvement on the property. So you can't just go buy a property and sit on it for 10 years. You actually have to, whatever you spent on the property, you're going to have to spend again on improving that property. Like there's some rules that you have to follow to make that qualify. But then, yeah, your gain, you don't have to pay. And it steps up on that day is the term, but the easiest way to think about it is, yeah, I don't have to pay any tax on it. I just haven't seen a lot that got me excited, and
I haven't heard a lot of good yet.
Yeah, when this came out, it was like a big thing, you still have to pay tax on, like, you, first off, you have to have qualified capital gains that you could roll into the opportunity zone. You got to put it in an opportunity zone fund and then invest in opportunity zone property. So you have timelines to do all this. So first off, if you put money in an opportunity zone without qualified funds, it doesn't matter. You're paying tax. There's no such thing as, hey, I invested in an opportunity zone, therefore I don't have to pay tax. No, you have to use qualified capital gains that roll into the opportunity zone that then you have to recognize in 2026. There was a step up, 7 years and 5 years out when this thing first passed, but now we're so close. You're just going to be recognizing the capital gain and recapture in 2026, and then you could wait 10 years and you don't have to pay tax on any of that gain. So, I'm always one of those guys that I want the money now.
It's a long hold.
Yeah. Otherwise, do a 1031 exchange.
Yeah.
Right. So, or do a lazy man's 1031 exchange by accelerating loss on other passive assets and offsetting your gain. Because then you don't ever have to worry about it. It's just, hey, I don't have to pay tax on it. It's great. That's me, though.
And you probably know your investment area better that way.
Yeah. Anyway, some of that seems like a red herring.
Yep.
Getting people to do things they wouldn't otherwise do for a tax reason. Kind of.
I'd be a little scared of it.
Yeah. All right. If you are an S corporation and pay yourself a regular salary, but also take money from what Intuit calls owner to draw, how is it taxed? Do all employees have to be W-2 employees under an S corp, or can they be contractors?
So we're gonna have some language lessons or definitions, I should say. First of all, basically with an S corporation, you have two streams of income. You have the reasonable wage, the salary that they're talking about here. And then you have what we call the distribution, often what they're called, Intuit's calling owner's draw. How's that taxed? Well, the W-2, as Toby pointed out earlier, that's going to be subject to employment tax. All of this income is subject to income tax, whatever your bracket's at, both streams. But the W-2 is subject to employment tax, so it's a little higher. Congress requires that. Why? Because they know that that income is what's going to get, a little bit put into retirement, et cetera, so on and so forth. And they'll let you put that into retirement plans, so on and so forth. But that other part, that distribution that's not subject to the employment tax, but it will get hit with income tax. And so those are the two streams that we often see in an S corporation. Now for a little bit of the definitions here, if we have any employees, do they have to be W-2? Well, by definition, if they're an employee, they are W-2, first of all. So that means you're going to pay half as the S corporation, the business, the employer, it's going to pay 1/2 of those employment tax, whereas the employees will pay the other half on their paychecks. Can they be contractors? Well, it kind of depends. It depends on what they're doing. They certainly can be, but you would want, in fact, you could be both. If you're an employee and then you do some side projects unrelated to your normal job there, you could be both theoretically. If you're a contractor, though, everything you pay for the employer standpoint, the S corporation, is just a deduction. And when the contractor receives it, all 100% of that on their side is going to be subject to employment tax. And of course, they'll pay income tax as well.
Yeah, think about this for a second. So let's just say that everything you said is absolutely correct. So let's say we have an S corp and you're a shareholder and it pays you, and you want to pay yourself as a 1099. You just undid the benefit of the S corp. Because if you just let the S corp do what it does, those profits would have flowed onto your return without being subject to employment taxes. By 1099ing yourself, now 100% of whatever you 1099 is subject to employment taxes. You just cost yourself 15.3%, or after a small deduction for half of the employment tax, 14.1. I can't help it. I always go nuts when somebody says 15.3%. Technically, that's not true. It's about 14%. But it costs you money. For every $10,000, it's costing you $1,400 is the easiest way to look at it. So if I'm paying Elliot, and Elliot is not an employee, but he's doing work for it, and I pay him 1099, I just get to write the whole thing off. If Elliot comes to work for the company and I pay Elliot, I have to pay half the employment taxes. He pays half the employment taxes. So it costs me as the employer. I have to do withholding. I have to run payroll. So it might be better to contract with people, but there's strict rules on contractors versus employees. You got to make sure that you're not controlling that individual. You're just paying them to do a job. Like, hey, paint this house. I could pay somebody. I could contract with them. But if I say, hey, I want you to be on board and I'm going to tell you what to do every day, and I want you to paint this house between, here's the hours I want you to work. That's an employee, right? Now, can you be an employee and a contractor? You get this question all the time. The answer is yes, with a huge caveat, right? If you're an employee as a service provider, for those services, you have to pay withholding. You're a W-2 employee. You're going to be subject to employment taxes and withholding, unless you're a shareholder, in which case then the distributions, the owner draw, whatever, the profits flow to you, and you're not subject to employment taxes. But if you do something unrelated to your services as an employee, so let's go back to the pizza shop, right? So let's say that Elliot and I own a pizza shop. Oh gosh, I can't help it.
Pizza, pizza.
So Elliot and I have a pizza shop, and Elliot works at the pizza shop, but then says, but I'll also be your accountant. And I have Elliot's tax services, and he's a sole proprietor or something. He could get his W-2 for being a pizza person from the S Corp, and I could still pay his company or him as his company, if he's a sole proprietor, a 1099. What I can't do is say, hey, I'm going to give you some money, Elliot, and we're going to 1099 it so we can avoid employment taxes. I'm pushing it all onto you. Can't do that. He's a W-2 employee for those services that he's providing for the pizza company. For his pizza services, he's an employee. You do something completely unrelated, yeah, I could 1099 people. And this is routinely, accountants will just say, no, you can't. And it's like, it's not quite that easy. The best example I had was somebody had they had a catering business, yet they were a secretary at a company, and the company wanted to pay them through their W-2 for their catering business. And they were like, hey, I have a separate business and it does this, and they want to hire my business. I don't want them to pay me because it needs to go to my business. I have other partners and other things. And I'm like, yeah, technically they would pay your business, not you as a employee. You're not doing that. So we were able to get that squared away so the employer felt comfortable saying, aha, okay, because our accountant kept saying, we have to pay you through payroll. It's like, no. Not quite that simple, right? There it goes. Talk all day. You have open-ended questions.
Yeah, they're great. They're great. Yeah.
And I don't know, you guys like learning this stuff? Because we could dial it back and just do 10,000-foot view too. But give me a thumbs up if I need some reassurance. Give me a thumbs up if you like the
There it comes.
There we go. All right, 3 thumbs apparently. 4, maybe 5. All right, now we're seeing some more. All right. Can an IRA balance be transferred to a founded? Now we're getting a bunch. We got some hearts too. Can an IRA balance be transferred to a foundation tax-free and also allow the owner a tax deduction? Can I create a foundation and operate the foundation receiving the contribution? Ooh.
Yeah, I kind of like this one. First of all, you can see, this is foundation IRA. When you're 70 and a half, you can start making what's called qualified charitable contributions. Is that the term? You qualified qualified gosh, I have it written down here, but I don't.
Is it a QDC?
Yes,
Qualified?
QDCs.
Yeah, deduct. Yeah, you can take money directly out of an IRA, and you're typically required to take a minimum distribution after the age of what, 73?
73.
So you can direct that into a charity. You can actually do it at 70 and a half. Some people are taking distributions because you can start at 55 or 59 and a half.
No.
55, then you have to make them equal. 59, I can start taking distributions out of my IRA.
But it's not a tax deduction.
Oh, hold on. If I push it over, so there's 2 ways to do it. I receive the money, pay tax on it, then contribute to a charity, and I would take a deduction. Or I could put up to $100,000 a year of my distributions directly into the charity, and now I don't pay tax on it, but I don't get a deduction. It just, that amount is not taxable. So if you have required minimum distributions, for example, of $50,000 a year, and you're like, man, I just wish they would go straight to a charity. I don't need them. I don't like paying tax on it. It makes my Social Security taxable. It pisses me off. Great. You could direct that into a qualified 501c3. 100,000 bucks a year, but you have to be 70 and a half or greater, and it has to be a qualified 501c3. So Elliot, can you use a foundation to do this?
Yes. Under 170, we thought it was 171A, I think it was, code section 171A. It has a list, laundry list. You often hear when it comes to charitable donations and things like that, we talk about DAFIs, donor advised funds. There you cannot, it cannot do one of these, but your foundations can, and certainly your public charities.
And it's true, they're being mean to you. Right? I would say if you're going to do this, you're on a line when you're dealing with a private foundation, which the easiest way to think about this is public charities do something, private foundations support the charities that do something, and they're required, unless they're a private operating foundation, like we go down rabbit holes here. A typical private foundation has to give 5% of its assets to another 501c3. So my suggestion is, if you're going to do this, is to set up a public charity, which you can automatically qualify for. We get a 5-year exemption, so you get it automatically, but do something with your charity. And it could be housing, it could be Section 8, it could be transitional housing, it could be something in science, it could be an amateur sports league, it could be teaching, like you could fill in the blank, feeding people, helping people, health. A lot of you doctors and dentists out there, you're already doing a bunch of service. You could literally set up your own charity that helps people in those routes. And instead of you taking the money from your IRA, you direct it. Now, can you do this with a 401k? No, but you can convert a 401k into an IRA and do it through that. And it's limited to $100,000 a year when you're 70 and a half or older. So there's a niche. Otherwise, you're just looking for stuff to donate. You can set up your own charity and say, hey, I keep getting all this money out of my retirement plan and it's ticking me off. How do I not pay tax on it? Well, you can give assets to charities. You could give money to charities. There's lots of ways to offset it. But if you want to avoid the tax hit from the distribution from an IRA, you do a qualified charitable distribution directly from the IRA into a qualified 501c3, which could be a private foundation. It's more than likely, I would say, you're safe as a public charity. It cannot be a donor advised fund.
And I think the Secure Act Part 2 bumped it up to 105.
Oh, you think
Yeah.
it went up?
And it's adjusted now.
It might be indexed, so
Yeah.
you would look each year. You think it's 105 now?
Yep.
All right. I'll take your
A
word
little
for
bit
it.
of redemption
I'd rather, I want every dollar. So yeah,
Yeah.
you'd run it and say, hey, how much can I contribute? So maybe it started at 100, now it's going up. So it must have had 5% inflation.
Yep.
All right. We sold our first flip at the beginning of this year. I would like to know if there is any way at this moment to save as much possible from being taxed, i.e. invested in the next flip or something else to avoid the loss. Also, we have a loss for our S Corp in 23. Could we see that capital gain to be offset in 2024? I have no idea what that.
Yeah.
Yeah.
So I think we got some terms confused here again. So that's why I kind of picked this, is because I can see that it's easy to get these things kind of mixed up. First of all, that first line, we're talking about a flip. All right. And we know we're in an S corporation. When we talk about flips, that is not going to be capital gains. That's ordinary income, not just subject to income tax, but also subject to employment tax that we were talking all the way back from question number 1. So I wanted to clear that out. There is no capital gain to be had here. I'm assuming that they had a loss in 23 in their operations. Well, that loss was taken in 23. It's an S corporation. It's a flow-through entity. So we saw that on our return in 2023. There shouldn't be any loss unless we had a net operating loss. There we're getting into some other rules, but yes, that would carry forward.
So they're thinking, I think, of 2023, they had a loss and they're like, hey, can we use that in 2024?
Right.
If you weren't able to use it in 2023, it can go forward.
Mhm.
Otherwise, you'd use it in the year that it was incurred.
Now, back to really, I think the heart of it, what can we do now? It happened in the early part of 2024. Are there any deductions and things? Absolutely. In an S corporation, you've got a whole lot of things you can start taking advantage of. You know, corporate meetings of your S corporation in your home, that's going to eat. That's into that income. That's 280A. We talk about that. You can use your accountable plan, adopt an accountable plan for reimbursements for mileage and for a home office, administrative office. All good things there. You're going to have maybe some income to pay yourself a little bit of the wage. We talked about that in one of the earlier questions. If we have earned income subject to employment tax, well, then we can donate to maybe a 401k we could set up or something like that. So there's a lot that can be done here to help us eat into that income that you've now gotten from your hard-earned flip. But just remember, it's not capital gains.
So, you know, the defined benefit guys
Yes.
that we work with,
Yeah.
Jeff, in them. So had a client, 1.2 million into a retirement plan, tax deductible. They'll pay tax when it comes out. It's not uncommon to be able to put $300,000 a year into what's called a cash balance plan or a defined benefit plan. These things, you have to have an actuary, which we could send you to, that does the calculation, but it's a huge amount of money. So when you see people making money in an S corp and they say, man, is there any way I could offset this income? The answer is yes. You know, we're used to 401ks and IRAs and HSAs. You're used to doing writing everything off under the sun from 280A, which is the Augusta rule, which is what Elliot was talking about, administrative office in the home, writing off your mileage and automobile expense, things like that. But sometimes we miss that there's big, huge tranches, even when we're getting hit with the tax or that we have this income, that there's still some places we can go. And those places are, hey, it's coming out as a salary. I could push it into a retirement plan. That's a DB plan where I could put in hundreds of thousands of dollars. There's actually something called captive insurance that you can create your own insurance company. You could put up to 1.4 million into that a year. Those are on the IRS dirty dozen list because some people abuse them, but if you do them right, they're just fine. There are things like contributing to charity. You set up your own charity, you could write off 60% of your adjusted gross income by writing a check at the end of the year. There are other things that you could do, like, hey, let me do short-term rentals and create loss. Let me start another business, create loss, accelerate depreciation to that year. Or, hey, I have rental properties. I aggregate them all together and make a real estate professional election and take that loss, right? There's lots of things that we could do, which, not to belabor it, is why you talk to guys like this.
And just one more thing I want to nail down, a common misconception. We asked here something about, could I put some of the money into the next flip? Well, what's going to happen there is that isn't going to be a deduction to you. If you started a new flip, what's probably going to happen with the most common scenario there is you went out and bought a bunch of boards or whatever, it's work in progress. You don't get any deduction for that until you finally sell later on. So you're not going to be able to defer taxes simply because you took some of your income and put it into a new project like another flip, that is. So just we run into that kind of misunderstanding quite a bit. I just want to nail that down.
Well, again, so whenever you say flipping, wholesaling, construction, real estate agent, broker, all those things, what I always hear is
Pizza, pizza.
Yeah.
it's a business, just like the pizza business. It's not real estate. It's an active trader business. Short-term rentals.
Pizza, pizza.
Yep. Pizza, right? We are a dealer.
Pizza, pizza.
Flipping properties.
Pizza, pizza.
Yep. It's all a trade or business. And it's not like you're like when you're an investor. And that's why, I mean, it helps to have people that actually know what they're doing in these areas so that you can get out ahead of it. Hey, I'm going to do this. All right, here's how it's going to be treated. Try this so we can get more benefit out of it. And usually it's big tranches of money. I know when you guys are doing the tax saver program, they keep a running total of how much they're it looks like it's around $20,000 or $30,000 a year, probably on average. There's people that they save $100,000 a year for. There's people they save $6,000 or $7,000 a year for. But yeah, somebody says I like the Little Caesar. I remember when that came out. I don't know. I guess they're big again, but I remember they kind of went through a lull. Speaking of a lull, here's Tax and Asset Protection Workshop. you're really bored. No, let's see. They're actually they're fun to do.
Mm.
Saturday, what do we got? July 27th is the next one. And then we have a live one coming up in September. We'll do some more between July 27th and September. We try to do them at least every other week, so that you can come in and learn about LLCs, corporations, land trusts. You can learn how to create a legacy. You can learn the tax implications of real estate. It's usually myself or Amanda or Brent or Clint coming out and teaching these. But we like to break it down so you get a good idea of what depreciation is, when you use 27 and a half years, when you use 39, when you use 5, 7, or 15, and then a bunch of other deductions that you may not realize you get. They're free. It's free to go to the workshop, unless it's the live one, in which case there's a small cost, but it's well worth it because it's 3 days, and this one's going to be in San Diego.
Not bad.
Yeah, like if there's places to go, San Diego ain't so bad.
Not so hot like here.
Yeah, it was only 120 degrees last week, but I always hear but it's a dry heat.
Still a heat.
So's fire, right? Doesn't mean I want it all over me. All right. What are typical operating or general expenses you've seen overlooked when investors file deductions?
Yeah, this one, I want to start, first of all, more on the theoretical. The way you avoid missing deductions is you have good bookkeeping, okay? That is your foundation. We've said it in many, many past shows. Your good bookkeeping is going to track all of the things that you spend on, which are your expenses. And it's very hard to lose or hide those expenses when you come tax time, if they've all been put into your bookkeeping. So that's the first place I'm going to start because you're not going to miss them then. Have good bookkeeping. It becomes much more difficult to miss deductions. What do we normally see? Definitely have seen depreciation missed on people who do a lot of real estate, rental real estate. That's a big one.
Can I put a timeout on that?
Yeah.
If you're not taking depreciation and you're renting a house, you got to understand this. You're not doing yourself any favors. You're not being benevolent. They're going to make you recapture what you could have taken, but you didn't.
Yep.
It's kind of like, hey, you could have this deduction. You're like, yeah, but it just creates a loss, and I don't need the loss.
Who wants to calculate that?
Yeah. When you sell the house, they're going to say, hey, what could you have written off? And you'll be like, your accountant will know. And they'll say, oh, look, you get to recapture it and pay up to 25% on the amount that you never wrote off. And you'll be like, what? Happens all the time.
It does. It doesn't happen as much. I mean, it is one that typically you're going to find taken as a deduction, but it happens enough, and it's so big that it's one that definitely warrants bringing up. But a lot of mileage gets missed. All of the operational expenses typically are in there. People are really good on that, from what I've seen. They'll get the operational expenses. It's the other expense, the property taxes, things like that kind of slide by. They just don't think. They're so much focused on the operations that they miss these bigger expenses. That's typically what we see. But again, to my point, and this is why I picked it, is if you have good bookkeeping, your chances go way down that you're going to miss anything. And you want to have that bookkeeping, because bookkeeping is your guiding point to know how well your business is operating. It's not just about the tax return. It's knowing whether or not this was a profitable venture or not. It's so critical. So that's kind of why I hit it, to really hammer that point home.
Yeah, and I'm going to make it easy for you guys. First off, Anderson does tax prep and bookkeeping, and we do the entities, and we're a national registered agent. There's close to 500 of us here, and we can handle your business work if you want us to. If you love your accountant, don't change, but you could still come here and do bookkeeping. Just reach out. If you just say, hey, I want to talk to somebody, put it in chat and they'll give you a link. It doesn't cost you anything to find out what it would look like. But what we like to do is we look at you. First off, we use a platform called QuickBooks Online, and we're going to say, hey, let's build your books together so you have an understanding of what expenses are treated, what way, which ones you're missing. And we're always looking for money. So if you're paying us something, my favorite thing to think about is, if somebody pays me $1 and I give them back $3, I'm a net benefit to them. If you're paying somebody 50 cents because you think you're saving it, but it costs you $3, it just costs you $3.50. Versus if you go to somebody who knows what they're doing, they should more than pay for themselves. And that's my experience with tax people. Don't skimp on taxes. They will pay for themselves and put more money in your pocket. And you'll be shocked at the big tranches of cash that come in when you do it right, and you can avoid a big tax hit. And especially using, we have a toolkit of about 45 different deductions and strategies that we use. And when they apply, and it might be 1, 2, 3, 4, who knows? But when they hit, it's usually kind of like, oh, little, oh, wow. I mean, it's going to save me $10,000 a year. Yep. For the next 20, 25 years. Yep. If you do it right, you can reap benefits for a long period of time, and then you really don't care. But you got to make sure you have people that know what they're doing, that do what you do. That's why I say always work with somebody who isn't their side gig. It's not the thing that they do. Hey, 99% of my clients are like this. Work with people who work with investors and business owners, please. Don't go to H&R Block or any of these other houses where somebody does it part-time during the year, and the rest of the year they're doing, they're doing roofs or something. All right. Can I move into a rental house I have had for 15 years? Does it still qualify for a 1031 at a later date? Or does it qualify for a 121 exclusion after 2 years? I always like when they put question marks and they're like, is it this or this? And both of them are wrong.
So could we have a rental and then move into it and still qualify for 1031? Probably not, because 1031 requires that it be an asset used currently in a trade or business. And if we've moved into it, I'm assuming we made it our primary residence, it's no longer in a trade or business. So we will have lost our 1031 capability at that moment. Now you could move back out, start to rent it again, put it as a trade or business again, and then do a 1031. That we could do. But the minute you moved in there, you took it out of a trade or business zone, if you will, or application. And so it's not going to be available for 1031 at that point. The next part, though, what about 121? Right, it was a rental.
What is 121?
Well, good point. Well, 121 is for our personal residences. If you've had it, lived in it and owned it for 2 of the last 5 years, you can exclude up to 500,000 married filing joint or 250,000 of capital gains single for when you later on sell it. The rules are that, again, 2 of the last 5 years of ownership and use as a primary residence. So in our instance here, you had a rental for 15 years. You move in it for 2 years as your primary residence. Now we can use the 121 there. However, what's going to happen more than likely is you're going to have a rating of the time that you used it as what we call non-conforming use, the 15 years as a rental. So you're going to use your total amount of time you own that house. How much time was it used as a rental? How much was it used as personal residence? And that fraction is going to be used against that 500,000 or 250. But you could, in this situation, if you qualify for the 2 years, now rent it out for a little bit after, we put it back in a trade or business, and you could do both 1031 and 121.
Yeah. So 121 is the capital gain exclusion. It's not a depreciation recapture exclusion. It's just capital gains. And it's up to $500,000 married filing jointly, 250 for single capital gains when you sell a house that you've lived in as a primary residence for 2 of the last 5 years. So you can get up to that and you use it first. 1031 exchange is when you sell an investment property or properties and invest the same amount or greater into replacement property or properties in the United States. If you're a U.S. citizen, you can even go into territories. But it's kind of fun because you could just keep rolling it forward and never pay tax. So where we see this rear its head is folks in highly appreciated cities like Austin, San Francisco, Seattle, Miami, people who bought things 10 years ago that were $500,000 and now they're worth 3.5, right? And they're going to sell it. And they're like, okay, they go to their accountant and their accountant says, well, you've owned it for these last 10 years. You lived in it. You get this $500,000 exclusion. And you're like, that's great. My basis is $500,000. I use a $500,000 of capital gain exclusion. That's $1 million. Now I have 2.5 million of gain at 20% plus 3.8 for the net investment income tax plus my state tax. I'm getting punched right in the neck and you're acting like you're doing me a favor. Here's what you do. Like Elliot says, you move out and you rent it, even for 6 months. make it a rental. Now it qualifies for a 1031 exchange. Now, when you sell that $3.5 million property, you still get your $500,000 of exclusion. Your basis is now $1 million in it. The 2.5 million of extra, you're rolling it into new property or properties. I just have to invest it in more real estate. Here's a question we get a lot. What if I want to move into the house that I bought? As long as it's investment property to investment property for a reasonable period of time, usually 6 months to a year, you can go move into the replacement house after you've established it as an investment. In fact, the tax code anticipates this. It talks about you have restrictions on when you do a 1031 exchange and move into it, that you can only do the 121 exclusion. I think it's 5 years instead of 2, but it contemplates that you do this. So yes, how much will it save you on 2.5 million at, close to 30%, in some cases higher? It's going to save you 750,000 to $1 million. I'm taking that action. I'm willing to say, hey, you know what? Let's go ahead and make it a rental. If you're flush with cash, then it's not going to be an issue. You can go buy your rent. Like what I would do is say, like, let's say I had me personally, we have hundreds of properties. I'd probably take a loan out against some of my commercial properties and go buy a new house, right? I'd turn my house into a rental and sell it, and then just invest in more rental properties, or use that money from the sale after I put it into the new rentals and pay off the loan from the first one, right? You could do that. Fun stuff.
Yeah, it is.
Drink it out of a fire hose, right, guys?
That's why we're here.
But the whole reason that we bring up these types of strategies is that most people are like, you can't do anything. No, you can go back and forth. I can go from a rental, I can make it into a primary residence. I can go from a primary residence, I can make it into a rental. Let me give you another example. I'm living this with a client right now. She moved to Florida, had a house in Michigan. She doesn't want to sell the house in Michigan. It has sentimental value. And she keeps thinking, like, what am I going to do? What am I going to do? I have this capital gain exclusion. She has $500,000 that's sitting on the table. And there's about $500,000 of gain in that property right now. Well, she moved out a year ago. So don't worry. What you have 2 more years to satisfy that I lived in it as my primary residence 2 of the last 5 years. There's no non-conforming use issue when you move out of a primary residence and sell it within 3 years. You don't have to worry about it. What we could do is sell it to, at that point, we create an entity called an S Corp, LLC tax as an S Corp, to buy the property from her, step up her basis, allow her to use her capital gain exclusion on that property, lock it in, so she never has to worry about paying tax on it ever again. It's one of the few times you'll ever hear me talk about having a property inside of an S Corp. And then we're going to accelerate the depreciation on that property because it has a new basis. We're going to elect out of an installment method. We're going to pay it over a long period of time, but we're going to tax it in the first year because there's no tax because it's capital gain exclusion. But what we do is we lock in $500,000 of tax benefit of capital gain erasure. Is the best way to look at it. Is now there's $500,000 of new basis that I'll never have to pay tax on, and we could still lock it in. Or she could just sell the property, or she could make it into a rental even after that. But we want to grab that $500,000. She and her husband they have it in their hand. They could lose it. They wait, but we have a safety net. There's always a safety net, guys. Almost always, I should say. If you know what you're doing, there's usually a way. All right, last question. Can you do a lease option assignment in a Roth IRA? Can you do a sandwich lease option in a Roth IRA?
Yes and yes. I had to look this one up. This is not my area of specialty, I gotta admit. The only thing I would say is I just want to make sure that it is an option, meaning sometimes people enter a written agreement that says option, but it's in practice by the IRS, they don't look at it as an option. That could be considered a sale, whereas if we did this really quick, maybe we're looking at some U-bit here or something like that. But aside from that, if we have a true option, true sandwich lease option, my understanding is yes, you can do them.
Yeah, so if you flip houses in a Roth IRA, and flipping means I buy something to sell it, and if you're doing lease options in such a manner to where it looks like you're doing that, and you do more than 5 or 6 of them, you're in a gray area. Anything, we've never seen an audit on this, by the way. But the reason it's an issue is because in a Roth IRA, if you run a regular business, a trader business out of it, it's subject to something called unrelated business income tax or taxable income, depending on whatever you're looking at. We call it UBIT. Everybody just uses that term, UBIT, unrelated business income tax, so that we know, oh, hey, there's a tax inside the IRA. The other thing that you can look at in an IRA is if you're using debt. So if you are borrowing money inside that IRA, expect something called unrelated debt finance income. It's another type of tax, and it does not exist inside of a 401k or a Roth 401k, but there's no way to roll a Roth IRA into a Roth 401k. You can go the other direction, but you can't go back. So if you have a Roth IRA, it's always worth having a discussion with your accountant before you pull the trigger on stuff. Right? You may say, hey, you know what? This is a strategy that I'll do in my for-profit world and not in the exempt entity world of a Roth where you'll never pay tax. You don't want to screw up the Roth. There's too many good benefits from it. So you just don't want to get yourself into a situation where you're like, nuts.
Yep.
All right, guys. Hopefully you had some fun. I know we're 5 minutes over. You know, we used to do these. We used to do them like 2.5 hours.
It used to be a
We
lot
used to
longer.
never have questions. We would just let it be a free for all, and then like 1,000 people would get on and ask questions, and it's so
Feverishly typing in the background trying to answer all.
yeah. Somebody says, "How can I learn more about Tax Saver Pro package?" That's interesting that you bring that up because I think I may have mentioned it. We do an analysis. Actually, Elliot and his team do the analysis, and here's how it works. You could do Tax Saver Pro. It's a set fee where they'll look at your tax returns and how many different strategies do you run it through? It's like 1,500.
Yeah, the software it's well north of 1,000.
Yeah, so they're doing different scenarios. They run it. You meet with the tax advisor. They're looking at your return, and if it's $2,000 flat. I'll just say that. So there's Patty probably has a link. It's $2,000, but we guarantee that we'll find you at least $4,000 of tax savings, or we'll just give you your money back. So if you run this through and it's like, oh crap, I'm not getting any serious benefit. You get $3,000. Yeah, great. We're going to give you your money back. The way I look at it is there's a way. Oh, Patty just gave you the free consult. They'll talk to you about Tax Saver Pro so that you can see whether that's something that's appropriate for you or whether you just want to talk to an accountant and see if they can save you money. I always say this, there's price and value, right? Price is what you pay, value is what you receive. I'm much more focused on the value side. The price doesn't really matter. If it costs me $10,000, but I save $1 million, it's a good deal. If it costs me $1,000, but it costs me $10,000 because I screwed up, then it wasn't a great deal, right? I'm always going to look at what's the value of what I receive, and most folks that are successful, that's what they focus on. So that's what we try to incentivize when people work here. It's like, hey, let us be a value add. Let us save you and put money in your pocket so that you're not sitting there going, dang it, I wish I hadn't done that. Or, oh, I wish I had talked to a tax person 10 years ago. And I've had people in my office that they realized they've been overpaying. In one case, it was about $25,000 a year just because of the way the accountant structured the business. One piece of paper saved them close to $25,000 a year. I still remember
It was Corp.
Yep, it was the S Corp. And the accountant, I literally got the accountant on the line and said, hey, why couldn't we do this? It's going to save about 25 grand. The client wouldn't believe me. And the accountant was like, oh yeah, you can do that. And the client just lost it. He was turning purple. And he was like, why didn't you tell me? But we're talking 20 years, 25 years they've been working together. And he goes, well, you never asked me to. And I'm just like, I'm a spectator at this point. Just watch that. I'm like, don't stroke out here, buddy. It's just money. But let's fix it from this point going forward. Yeah, it sucks that you realize that you had an accountant and not a tax planner, right? You got to have a tax planner on your team, and they're worth their weight in gold. So Elliot's actually very valuable.
Got a lot of weight.
No, his whole team is very valuable. All right, guys, if you want free information, you like this type of information, come on in. We also post, I think we post the recordings. You guys will get access to the recordings of this. If you want to go back and look at anything, don't forget to register for tax and asset protection. They're free. They're about every other week, and it's lots and lots of fun. And if you have questions in the meantime, just send them to Tax Tuesday at AndersonAdvisors.com. Just know that Elliot is looking at those and he steals the questions, and sometimes we answer them live. We will not call you out and make fun of you. We might make fun of you, but we won't call you out. All right. So hopefully you guys had fun. There's a couple more questions. I want to thank Matthew, Arash, Jeff, Jared, still on, Dutch, Amanda, Tanya, Douglas. Oh my gosh, we got a lot of folks on there. And they're all kicking butt. So we have tax attorneys, CPAs, EAs, and accountants answering those questions. They answered well over 150, and there's still a few that are left open. So what I'm going to do is mute myself and turn off the video end for now. But if you have a question that's not answered, hang tight. They will answer it before we are off. And I will say, see you in 2 weeks.